Very simple. We are starting with a simple question. And first we see the requirement as usual. It says that what is the amount of consolidated consideration attributable to Petronic for the acquisition of Sardonic, the parent's contribution. So it says on 1st August 2007. So please always pay attention to the date. Petronic company purchased 18 million of the 24 million equity $1 shares. So it is buying 18 million out of 24. Probably it is something like 75%. $1 equity shares. The acquisition was through a share exchange of 2 shares in Petronic for every 3 shares in Sardonic. So the parent is giving its 2 shares for getting 3 in the subsidiary. So 3 shares of subsidiary are purchased, and in return 2 in the parent are given.
Sorry.
Yeah. The market price of a share in Petronic company on 1st August is 5.75. Petronic also pay in cash, not now paying, will also pay in cash on 31st July 2009, which means 2 years later, 2.42 dollar per acquired share. So for each acquired share, it is also going to pay $2.42. And the cost of capital is 10%. So which means the discount rate is 10%. So very simple. You are making a share exchange, and you should always do it like this. Keep one column broader and another column also broader to show your calculations. And then the last one is for calculation. So there is a share exchange and there is a deferred consideration. So there are 2 promises, okay, 2 things which we are going to give. So share exchange, we are buying 18 million shares, and I use always 3 zeros because 3 zeros I put on the top. 18 million shares we purchase, and for every 3 shares we are giving 2 shares. So you can call it like 18 million multiplied by 2 divided by 3. So for every 3 acquired, you are giving 2 shares, and your current market price of 1 share is 5.75. So this is the value of shares which you are transferring to make this acquisition, and when you put it equals to, it becomes 69 million. And remember that there are 3 zeros on the top. So we talk about millions, and then there is a cash consideration. You said that $2.42 per acquired share. So for every 1 share, you're going to give $2.42. So how much that makes? 18 million. I would just write it like this. Okay, I would call it here 18 million multiplied by 2.42. Multiplied by 2.42, and then this price you will give after 2 years. So divided with 1.1, you are going to discount it and divide it 1.1. So 2 times you have to divide. So either you can do it like this, but that's not a very professional way. You should be doing it 1.1, and you should say power 2, because 2-year discount factor you have to make, and your discount rate is 10%. If it had been 8%, we would have done 8%. And now we put it here, and let's see what number comes in. So it's 36. You make a total, and it gives you 105 million. This is your answer. So it means that the consideration from, or I would say attributable to Petronic. So Petronic company will pay 105 million to acquire 75% of this company's Sardonic. Pretty simple question, not very difficult, not very technical. So this part, actually, this one, the deferred consideration, this is something which you have to pay after 2 years. So actually, how much you have to pay after 2 years? You have to pay 18,000 into 2.42, like 18,000 share, and each share you have to pay $2.42. So you have to pay actually 43,560. But this 43,560 you will pay after 2 years. You need to find out the present value of this. And you remember the formula of present value. The formula of present value is future value divided by 1 plus I, and you call it power n. So we will say our future value is 43,560. We divide it with 1.10, because 10%, like it is like 1 plus 0.1, which means 1.1, and you call it power 2 because it is after 2 years. And when you put it here, you get the number, which is 36,000 or something, 36,000. So this actually was 43, but it is after 2 years. But when you calculate the present value, so this is 36, because deferred consideration, you have to record your current value. So this is your 105 million is the contribution, which the consideration which is paid by the Petronic company. Okay, now let's do question number, next is coming 235. 235, it says that on 1st April 2000, Pecan company acquired 75% of Senders equity shares by means of a share exchange and an additional amount payable on 1st April 2001, which means 1 year later. So it is, we are talking about deferred consideration. No, I'm sorry, it's not deferred, because it says that was contingent upon the post-acquisition performance of Sender. If you remember, I told you that consideration you can give in form 4 ways. 1, you pay straight cash. 2nd, you give some shares. 3rd, you make a deferred consideration like this. You make a promise that I will pay, but after 1 or 2 years. The 4th one is called contingent consideration. Contingent consideration means conditional, which means that if certain conditions are met, like certain performance conditions are met, we will pay extra. So here they are paying something by share exchange plus a contingent consideration. And what is the contingent consideration? It is 4.2 million, but by 31st March 2001. So it means next year. After 1 year, we may pay 4.2 million. Would be paid out by 4.2 million. It was clear that the amount to be paid would be only 2.7 million. Okay, let me see. It says at the date of acquisition, Pecan company assessed the fair value of this contingent consideration at 4.2 million. So when you purchased, you thought you would pay 4.2. This was your estimate. But by 31st March 2001, like by the end of the year, your estimate decreased. Why your estimate is decreasing? Because maybe the company's performance is not good. Maybe the business which you acquired is not doing good, and therefore you will decrease. I mean, this contingent consideration, it depends on certain profit levels. If those profit levels are not being achieved, then you would not pay full 4.2. You said, I'm going to pay 2.7. Using the drag and drop options below, demonstrate how Pecan company would account for this 1.5 million adjustment in its financial statement. So your contingent consideration is actually decreasing. Okay, you promised 4.2, now you are going to pay only 2.7. So you should consider that it is actually what it was your liability you had to pay, and your liability is decreasing. Whenever your liability decreases, so current liabilities you should be making, debit. So current liabilities are debit. That is for sure. Debit current liabilities. I have to decrease my liability. Before I credited 4.2 million, now I would make a debit of 1.5 million so that my liability becomes down to 2.7. And what should be credit? Credit should be retained earnings, because this is a gain for you. It's not. It has got nothing to do with the goodwill. It is a gain for you because you had to pay and now you will not pay. So when liabilities will decrease, your retained earnings would increase. In any case, I mean, if I have to show you on the balance sheet side, I mean, the question is done actually, but let me show you physically if you want to see how does it work on the balance sheet. Remember, I had equity here. So probably on my equity side, I had, here is my equity, and maybe my equity was, say, I don't know, 1 million, and my liabilities were here. say 5,500,000, and the sum total of equity and liability was 1,500. On this side, you had your non-current assets and you had your current assets. Okay, let me put something there. I'm just giving further explanation. Actually, question was done, but just want to discuss so that you understand it fully. So you had your non-current assets probably 1,000, you had your current assets 500, and your balance sheet was equal. So you had 1,500 on the asset side, you had 1,500 on your liability side. Life is good. You are happy. Then what happens? You said that I'm going to decrease it. You know, like in this case, when you said that your contingent consideration is decreasing, it means that your liability is decreasing. So you want to make it 400. When you decrease it, your balance sheet does not remain equal. It should be 1,500. But when I decrease my liability, will it increase my current assets or non-current asset? No, it does not. I mean, your cash will not increase. Your receivables, inventories will not increase. Your building, land, property, plant, nothing will increase. So, or nothing will decrease. I mean, if I decrease 100 from here, it does not mean that I should be decreasing my current or non-current assets. My current non-current assets were same as they were before. So what do I do? I cannot subtract 100 from here. Okay, in order to make it equal, I cannot. What I do, I add 100 here in my equity section, which is my retained earning. So this is a gain for the business. The business proposed or supposed that they had to pay 4.2. Now they're only paying 2.7. So whatever 1.5 million is the reduction in liability, that would be an increase in the retained earning, because you have to make equal. So your double entry should be debit your liabilities, whatever they are, and credit your retained earning. So this is how you will treat it. Debit liabilities, liability go down, credit retained earning, it goes into the retained earning thing. So this is just some how to say explanation further. I mean, the question was pretty simple. You just need to know the treatment that if you, and by the way, it would have gone otherwise if it had increased. Let's suppose that you say that from 4.2 million it goes to 5 million. Contingent consideration increases. In that case, your liability would increase. In that case, you would say credit liability and debit retained earning, the opposite of that. 236, Crash Company acquired 70% of bank company, $100,000 one ordinary shares for 800,000. Please listen to me carefully. Our focus should be on the long questions from consolidation. But consolidation long questions are nothing different than a 5 short question. Whatever concepts we have to use in the long questions, we need to learn them here. Once you understand these short questions and then we go to long one, it would be easy because you will use the same concept, the same calculations there as well. So that's why I'm spending a lot of time. That's the starting point. I mean, jumping onto this long question straight, you would be absolutely confused. So let's solve them in small pieces and then we go to the bigger part. So Crash Company acquired 70% of bank for $100,000, $100,000 one ordinary share. So 70% you are buying, which means 70,000 shares you are buying for $800,000 when the retained earnings of bank company were 570. So question is, what is the goodwill? Now, if I don't know this one, if I ignore this one, I can find out goodwill from here. You know why? How? Because what is happening? We are paying 800,000. And what are the net assets? You remember that the formula for goodwill. The formula for goodwill was that goodwill is equal to consideration paid minus net assets at acquisition. At acquisition, that's important to remember. So how much is the consideration which you are paying? Consideration which you are paying is 800,000. Okay, you paid 800,000. And let me put it for 800,000. And then what are the net assets? The net assets means equity. The net assets means total asset minus total liabilities, or otherwise you call it equity. Net asset includes share capital plus retained earnings plus share premiums and reserves. So share premium and reserves are not given, but share capital and retained earnings are given. How much is the share capital? The share capital is $100,000. If you pay attention, this company has 100,000 shares of $1 each. And how much are the retained earnings? The retained earnings are given as 570,000. So it means that this business, their worth is 670,000 and you are paying 800,000. So naturally speaking, your goodwill will be a difference between 800 minus 670. This is 130,000 goodwill. If I ignore this part, see, if I ignore this part, answer should be 130,000. And they gave it to you just to confuse you, because you will calculate 130, you will see the answer. Oh, 130 is there. I got it correct. No, we need to read further. Now let's see. In the absence of this part, answer was 130,000. But now let's read further. It says that bank company also has an internally developed customer list, which has been independently valued at $90,000. Now, this is an intangible asset. It's a customer list and it is internally developed. Should you consider this as your intangible asset on the bank company balance sheet or not? The non-controlling interest in bank company was just to have a fair value of 220,000 at the date of acquisition. What was the goodwill arising on acquisition? Okay. So what we need to do now? What we need to do, we need to first find out how much is the consideration. So this consideration, which we paid 800,000, this is for 70% by the parent. Okay, this is 70% by the parent. But you know that there is a 30% also by NCI. So how much is NCI? They gave you in the question that the NCI, the value of NCI, the non-controlling interest have a fair value of $220,000. So here I say NCI, which is 30%, is 220,000. So it means that the total value which is given to acquire this subsidiary company, bank company, it was given 1,200,000. We call it total consideration. Total consideration means consideration from the parent as well as consideration by the NCI. Total is 1,020,000. And now we say, what are the net assets? The net assets are share capital, which is 100, retained earning, which is 570, and the customer list. This customer list, you should pay attention that usually internally developed intangibles you do not recognize. Under normal conditions, internally developed non-current assets you do not recognize. But they told you that which has been independently valued. It means that a third party has valued that thing, and that's a verification. And then you can include it. So I would say 90,000 is the customer list value. So the total assets are 760,000. And here comes 1,020,000 minus 770. So you get 260,000 as your goodwill. What was the goodwill arising? So we don't have this answer here, 260,000. Did we make a mistake here? 100, 570.
If you don't include customer list, you're getting 350.
But why should not be?
No,
Okay, so actually customer list, I did not probably read the question. Listen, bank company also has an internally developed customer list, which has been independently valued at 90,000. Okay. I'll just remove it. You know why? I thought because they usually, I just was kind of my own frame of mind. I thought that they did not include. Now let me tell you what was the confusion. Why did I do it? See, many times it happens that they say that which was not included, and then you have to decide should I include it or not. It says that bank company has an internally developed customer list which has been independent valued. So it was already inside. I mean, whatever your assets were in the bank company, it does not say that they did not include and you must make a fair value adjustment. It was already included. So here in this question, the trick is that sometimes students they may think that I should subtract this 90,000. So if you subtract this 90,000, this type of situation could have happened. But you just do not need to do it because it is already included. They did not write it here that it is not included. I just thought by mistake that maybe it is not included, but it is already included because it is not said in the question that it is not included. It just says that there is a customer list which is independently valued at 90,000. So it means that they included it, and logically they should be including it. The thing is that they should be including it and they have already included it. So you just ignore this 90,000. So this was the, I'm sorry, it was my mistake. I thought that they have not included it. But when I read the question carefully, they are not saying that it is not included. So it is already included and it should have been included. So you just ignore this thing, this customer list. Yes, if they had told you in question that it was not included, and then you have to take a decision, should I include or not? I mean, if they say in the question that it is not included, and you have to take the decision that should you include or not. So then, based on this sentence, which says independently valued, you should be including it. But if they do not use the word independently valued, then you cannot. So this was actually the how to say trick. Okay, so it should be 350,000. It was simple, but I just made it complicated. We do 237. 237. If we do 237, yeah, this one. Phantom Company acquired 70% of the $100,000 equity share capital of Ghost Company, its only subsidiary, for 200,000 on 1st January 2009, when the retained earnings of Ghost were 156. At 31st December 2009, retained earnings are as follows: Phantoms and Ghost. Now you know that there is something which is called acquisition date, post-acquisition period, pre-acquisition period. Your acquisition happened on 1st January 2009. You are preparing financial statements on 31st December 2009. When you acquired, the retained earnings were 156. End of the year, the retained earnings are 177. So this difference in the retained earning is called post-acquisition retained earnings. I'm just explaining some numbers. We'll move forward. Okay, Phantom Company considers that goodwill on acquisition is impaired by 50%. So Phantom Company considers that goodwill on acquisition is impaired by 50%. Non-controlling interest is measured at fair value, estimated at 82,800. Using the drop-down box, select what group retained earnings should be there. Okay. Now that question needs a little bit of working. First of all, you have to calculate what is the group retained earning. Okay, and the thing is that group retained earning must include the parent-owned retained earning, which is 275, plus parent's share in the change in this one, and plus minus any impairment of goodwill. Because if goodwill impairment is happening, it will decrease the retained earning of the subsidiary. So first we need to find out the goodwill, and then we have to impair that goodwill, and then we have to give the share to the parent. So let's first find out our goodwill in this question. So let me clear it. So how do we do that? We say that first we need to find out the consideration. Okay.
I think around 26,800 will be the goodwill.
Let's see consideration. So parent is giving how much? Parent is paying 200,000. And that 200,000 is actually 70%. So it means that there is a 30% which belongs to NCI. And NCI, they gave you in question that the value of NCI is 82,500. They gave you in question, okay? 82,800. I'm sorry, 800. So it means that the total consideration paid is 282,000. Now, out of 282,000, this I would call it, you call it consideration, and sometimes you also call it value of investment or cost of investment. Let's call it like this, cost of investment. These are the two names. You can use them alternatively. And then you need to find out, you call it net assets of Ghost, the subsidiary, at acquisition date. This is very important to remember that at acquisition. So they have share capital, which was, if I'm not wrong, 100,000, and it had some retained earnings. Retained earnings also on the acquisition date. Okay, I'm not taking 177, I'm taking 156,000, which is the retained earning on acquisition date. So here I make a bold. And then you have a goodwill, which of course is a difference between these two. 282 minus 256. So 26,800 should be your goodwill. That's pretty simple. Now, then what happens? You would say impairment. 50%. 50% impairment has happened. So if 50% impairment has happened, it says that that goodwill on acquisition is impaired by 50%. So I take this multiplied by 0.5. So 13,400 is the impairment which has happened. And then what happens? This 30,000 impairment, when it happens, now you say that subsidiaries, you call it now. Now they ask us. Now this is what we have done, but they did not ask us to do it. Our target is to calculate group retained earnings. Okay. And group retained earning is what? Let me first write down here. Group retained earning. Group retained earnings should be equal to, why I'm doing it, I will explain you. Group retained earnings are equal to parents retained earning, which are given to us as 275,000, plus you say that, plus parents share in post-acquisition retained earning of Ghost. Like whatever the post-acquisition retained earning of Ghost, inside of that, how much share belongs to the parent. This is group retained earning. I mean, you watched those videos from our F3 lectures, and we did many questions like this. Parent retained earning plus parent share in the subsidiary. I mean, if I ask you how much is group, what includes in the group? The group includes of the parent plus 70% share from subsidiary and subsidiary's profit. And which profit? The profit after acquisition. Okay. So you need to know that plus parent share in post-acquisition. I say post-acquisition. Okay. After acquisition. So let's first calculate Ghost post-acquisition retained earning. How do you calculate Ghost post-acquisition retained earning? You will say that retained earning at reporting date, which is 177,000, less retained earning at acquisition. Like when I say post-acquisition retained earning, which means retained earning after acquisition, total is 177, but out of this 177, 156 was already there. So it means that the post-acquisition retained earning is 21,000. Okay, it should be 21,000. Now, this is what you call post-acquisition retained earning of ghost company. But the issue here is that I cannot take this 21,000 because there is some loss of, there is some impairment of goodwill. And that impairment of goodwill will decrease the profit, will decrease the retained earning of this ghost company. This should be subtracted. So now what I calculate, so this is, I call it adjusted retained earnings or adjusted post-acquisition retained earning of ghost. So ghost actual retained earning is only 76 because on the balance sheet it shows 177, but out of 177, 156 was already there, which was coming from the previous period before the acquisition. So you subtract it, it becomes 21. Now you could take 21. This is the post-acquisition retained earning if there had been no impairment. But in this question, there is an impairment which is happening. So that impairment will decrease. So we subtract the impairment loss, okay, and it comes out to be 76. So this is subsidiaries, the ghost retained earning, and then what we say that parent share and we say NCI share, and very logically, parent will take 70%, and of course NCI will take 30%. So I can say that 7,600 multiplied by 70%. This should go to the parent. This is parent's share of the ghost profit, and this share will go to NCI. This is NCI share. So what we need to calculate, we are interested in the parent share. We take this number 5320. So the parent will take 5320 from how to say your
Ghost.
from ghost, and then you take it up on the top, and which is here 5320. If we did it correct, and we come to the number 28320. That should be the answer. Any question until here? So this is actually 283.20. This is your answer. You call it parents retained earning, the group retained earning. So this is what they had asked us actually. This was the requirement. But in order to get this number, we needed this thing, the post-action retained earning of subsidiary. But in order to calculate post-action retained earning, which we did here, we needed some impairment of goodwill. And that's why we calculated goodwill. I mean, if there is no calculation of goodwill, you would have just not calculated goodwill, just had taken this 21,000, take 70% and added here. So this would have done. Now that's a simple question. I mean, very basic conceptual thing. Now, maybe if I ask you one more thing, let me ask you, NCI, the non-controlling interest. Now I'm just going to add some a different perspective to this question. You have NCI. NCI means the non-controlling interest, the third party which is investing that 30%, okay? So you have two calculations of NCI. One is called NCI at acquisition, which usually is given in the question. And in our case, NCI at acquisition was this much, 82,800, okay? It was given in question that NCI was 82,800. This is called NCI at acquisition, which is 82,800. Or they may ask you, how much is NCI at reporting date? So NCI at acquisition means that NCI at the beginning, NCI at reporting date means NCI in the end, like NCI on 31st of December. And of course, that would be acquisition plus minus the profit. So if they ever ask you, how much is the NCI at acquisition? If they ask you, they did not ask you this question, but let's suppose they ask us, how much is NCI at the reporting date? You know, your answer should be like this. You should say that NCI at reporting date is NCI at acquisition, and this one, and this one. I would say plus, instead of word parent, I would say NCI's share. This is like this. That makes logic. So how much is the NCI at the end of the year? You would say the NCI at the end of the year is actually equal to NCI at the beginning, which means on acquisition, plus whatever the subsidiary profit, NCI share inside. So this is 82,800, and this one, this 22,800. This will give to NCI, and your NCI at reporting date will be 85,080, whatever it is. So now this is your NCI value at the end of the reporting period, if they had asked you. We just created one more scenario. I mean, out of one question, we created another question. It was not given, but we just created ourselves. Now let me further play with this question. I want to explain some concept here, which we will not do the question, but I will just throw the idea, and then when the question we will face, we will solve it. Now, one big question is that there is a goodwill of 26,800. Okay, we know that the goodwill is 26,800, and we also know that the impairment of goodwill is 13,400. So goodwill has lost value, and this is called impairment loss. This is a loss. Now the question is, there are two parties: parent 70%, NCI 30%. This goodwill is actually a kind of extra amount which you have paid. It means that when you pay more than the balance sheet value of assets, okay? Now, who does this goodwill belong to? Now, the question here is that this goodwill, let me separate the numbers here. This goodwill, which we are calculating as 26,800, who does it belong to? Who does it belong to? Does it belong to the parent or does it belong to the subsidiary? Who is paying extra? One or both of them? And the second question is, if there is any impairment, it is a loss, who should take this loss? This loss belongs to whom? The parent or the subsidiary? That is one a little bit critical calculation. So you should remember that NCI, measurement of NCI, you've got two principles for measurement of NCI. One is called fair value, which means the market value. And one measurement of NCI, another method. So I'll just put it here. Measurement of NCI, you've got two options. One is called the fair value method, just like we have been doing. And the second is called proportionate of net assets. We have not done any question so far with this proportionate of net assets. Proportionate of net asset means that you would see what are the net assets of this company. For example, this company, we said that their net assets are 256. Okay, this were the net assets. Okay, you take 256 multiplied with 30%, that would be the value of NCI. If you had done like this, like 256,000 are the net assets multiplied by 30% because NCI belongs 30%. So if I had done it, okay, let me put it here. If I had done it like this, so it would give me a number. It would have given me a number of 76,800. But in the question, they told us that the NCI value was 82,800. We took it at fair value. So remember, whenever you do fair value measurement of NCI, you say that NCI takes a portion of goodwill. whenever fair value NCI measurement is done at fair value, some part of the goodwill belongs to the NCI as well. Like whatever goodwill amount is there, it is 26,800. 30% of that belongs to the NCI also. But if you measure NCI at proportionate of net assets, if you have done it at proportionate of net assets method, then in that case, the goodwill does not belong to NCI. Goodwill will only belong to the parent in that case. Like proportionate of net assets, if you had done, then the entire goodwill belongs to the parent. Then NCI is not paying goodwill. So you should remember that. I would call it here goodwill. Okay, no goodwill. Let me call it like this. No goodwill to NCI. I'll repeat the rule again, and then I will show you through calculation. I will prove it what I'm saying. I mean, first we need to understand the rule. The question which I raised was that if we calculate a goodwill, which in this case is 26,800, whom does this goodwill belong to? To the parent, to the NCI, or to the both? The answer is that NCI has two types of valuation method. You measure NCI either on fair value or on proportionate. If in the question they tell you that NCI is measured at fair value, it means that NCI is also taking some part of the goodwill, which is 30%. NCI becomes the owner of the goodwill. And also NCI becomes a loss-bearing impairment. So if any goodwill is there, 30% belongs to NCI. If any impairment is that, 30% of loss will be taken by NCI. If it is done on fair value, just like they gave us in question. However, if you are measuring NCI on proportionate method, proportionate of net assets means that their net assets are 256. You take 256, multiply by 30%, and you say this is the value of NCI. Then there is no goodwill to NCI. Then NCI has got nothing to do with the goodwill or with the impairment of goodwill. Goodwill, impairment, goodwill are not related to NCI. Why it happens now? This is the rule which I told you. If you ask why it is like so, you see, if you see the numbers here, the net assets of this company are 256. And out of this 256, what you are doing, you say that $256,000 company, 30% belongs to NCI. And you are NCI. Your name is Karthik. I say Karthik, you are the owner of this company. 30% I'm giving you, but you must pay me 82,800. You will immediately say that, sir, 256, 30% of 256 is 76,800. Okay. You are giving me a company which is worth only 256,000, and I'm getting 30% of that. It means that I'm just getting 76,800. Why are you asking me to pay 82? So if you pay 82, it means you pay extra. It means you also have some goodwill. But if we agree with you, okay, you only pay 76,800, which means proportionate of net assets, you say I'm only paying 76,800. So it means you are not paying any goodwill. You are just goodwill is when you pay more than the net assets. You are not paying. If you are saying I'm doing proportionate method, it means that you are not paying more than the net assets. You are not paying anything extra than the balance sheet. So then there is no goodwill to you. Now in this particular question, if we try to do it and we try to relate to numbers, we were told that NCI is 82,800. This is what they told us, the value of NCI and fair value, 82,800. If we see the net asset proportionate method, if I multiply it with 30%, it would have become 76,800. Okay. So how much I'm paying extra? Let's now calculate. 82,800 minus 76,800. If I make a minus, it means that NCI is paying 6,000 more. Okay. NCI is paying 6,000 more. So it means that this is the amount which NCI is paying extra. And that part goes to the goodwill stuff. That part goes to the extra payment, belongs to the goodwill stuff. So this is what you need to remember, how to say the measurement of NCI either at fair value or at proportionate method.